back, ladies and gentlemen. Now we move on to the next panel discussion for the day, also the last panel discussion for the day. And let me invite our eminent panelists. Mr. Anand Sharma, the Portfolio Manager, PMS ICICI Prudential Asset Management. Mr. Sharma joined IPAMC in April 2014, and in his current role, he is a portfolio manager for 2 of IPAMC's PMS strategies, ICICI Prudential PMS FlexiCap strategy and ICICI Prudential PMS Wellness strategy. He has also covered pharmaceuticals, healthcare, metals, mining, sugar, and textile space as a research analyst. We have on the panel Mr. Karthik Kumar, Portfolio Manager, Axis Asset Management, who has over 10 years of experience in building and managing quantitative strategies for India and for the Asia-Pacific region. And prior to joining Axis AMC, he was based out of Hong Kong and served as a portfolio manager at Silvertree and ASIA Investments. We have with us Mr. Amit Jeswani, the founder of Stallion Asset. Mr. Jeswani is a double charter, has successfully completed his chartered financial analyst from Virginia, USA, and chartered market technician from New York, USA. He has been investing.
Did we lose the audio?
Yes, seems so.
Seems like.
This panel will discuss the philosophy-based versus quant-based asset management for alpha generation over the next decade. And the session will be moderated by Mr. Ratish Pandey. Now, let me introduce our moderator to you. Mr. Ratish Pandey has over 35 years of corporate experience in India and overseas in senior management roles across multinational companies. He's skilled in a multitude of areas such as business strategy, setting up and developing profitable businesses, team mentoring, and business transformation. As a business coach, Mr. Pandey utilizes his extremely business transformative acumen, his lifelong learnings and experiences to assist SME business owners in addressing their challenges and achieve higher growth. Mr. Pandey, warm welcome to you and warm welcome to the eminent panelists as well. Mr. Pandey, the stage is all yours.
Thank you so much, Aishwarya, and welcome to the eminent panelists. You know, Anand, Amit, and Karthik, welcome, warm welcome, folks. These are the guys who make money for you. So I would suggest let's just focus on what they have to talk about. And of course, very interesting topic, you know, philosophy-based and quant-based. You know, when I think of, you know, the philosophy-based human investing and the quant-based, I'm actually reminded of the left brain, right brain. You know, is there some emotion involved, or its computers are emotionless? And I'm also, you know, reminded of Nobel laureate Daniel Kahneman and his brilliant book, Thinking Fast and Slow, where he talks about system 1, system 2 thinking. You know, you sort of take a decision with your emotion, but justify it with logic. And I love to hear all of them as to how they look at, and you know, and believe me, they're all experts in their domain. They're successful managers of money, if I may use that term in a large fashion. But really, these are the guys who I have a whole bunch of questions, and I'm sure each one of you attendees have questions. So please make the session as interactive. I'm sure we'll find time for the panelists to answer most of them. So here we go. Let me start off with the first question. And this is open actually to all the panelists, and you know, whoever wants to jump in first. So the first question is very, I think some of us may not know what is quant investing. And you know, if anybody can jump in amongst the three of you, Anand, Karthik, or Amit, to you know, just tell us what is quant investing.
If I can start.
Sure.
Okay, quant investing is a very generic term like fundamental investing, and it encompasses a range of strategies going from high frequency to mid to low frequency strategies. You can also call them black box strategy to white box strategies. Now, what I particularly do is more a factor-based approach to quantitative investing, which is a more mid to low turnover strategy. in this process, essentially what you do is you take parameters that are used by traditional managers or that are used in traditional approach, but the difference is in the way one selects these parameters and finally implements them in a systematic framework without any biases to name or a sector.
Sure. Anand and Amit, would anybody would want to jump in?
I think Karthik said it right. He uses factors for it. It's high frequency. It's basically rule based. As long as, so we all globally, every investor follows an investing philosophy or a process. Be it Warren Buffett, he follows some factors, which one of my colleague Karthik said. Those factors are consumer-facing businesses, majority of them, high ROC, very strong moats around the business. So those are factors, majority of which can be quantified over longer periods of time. It looks something like a Paul Tudor Jones, who's one of the best hedge fund managers. He buys reversals. So whenever a stock or a commodity is oversold, that's when he gets in. Something like a Jesse Livermore, who's the father of technical analysis. This guy used to buy breakouts or trends. That was also somewhat rule-based. It was not computerized. But Ed Sekiota, a person who's compounded capital at north of 40% for last 4 decades, has been doing trend investing, and he's been doing it successfully just by following trends, following momentums, as long as, so there is no right wrong in this quant-based philosophy, as long as your philosophy is consistent. It can be on a computer system or not on a computer system. As long as you have a consistent philosophy, it's going to work well.
So the trick really is to get the factors right.
Right. Absolutely.
Yes, Anand.
Choose your factors. There are people who've done dollar cost averaging, people that average this dip, and there are people who are doing pyramiding. Yet, both of them, as long as you do it consistently, make money. So I know the question was, what is quant investing? But here people are more interested in making money. So I was just telling them, it is just following your rules. As long as you follow your rules consistently, do whatever kind of investing, you're going to make a lot of money. But yeah, sorry.
Yeah, just to add to, when Ratish started off, right, it's like you have a right brain, you have a left brain. Actually, even somebody who follows a philosophy-based investing, right, he or she, whenever they put the client's money, right, they also have a set of rules. So actually, eventually, in many times, what happens is that many of us who even do a philosophical-based investing kind of, end up combining the two philosophies without actually knowing it, because even a philosophical investor, right, would use some metrics, like whether it could be market share gains or whether it could be return ratios, etc. So there are rules for every kind of investing. It's just that I would say philosophy investing kind of at some level there is an element of storytelling involved in philosophical, whereas quant, I mean, as all of you all have said, right, I mean, it just, you feed data into a computer, into a system, right, and you use that data as it has to be used.
Great. And Anand, actually, your answer gives me a segue into my next question, which is, what are the main similarities between fundamental or philosophy-based and quantitative strategies? So maybe we start with you. And then we can sort of,
so as I said, right, even somebody who follows a philosophy, right, so essentially philosophy, in some sense, right, it comes from the way you have actually seen stock markets evolve over your phase of life. Right. So, for example, somebody who is born today, or probably somebody who's investing today, right, for him or her, interest rates might not be that big a factor as it was for somebody who started investing, say, 15 years or 20 years back. So I think some of these rules, even in philosophy-based investing, whether you used return metrics, whether you used valuation metrics, some of these always, they are a factor of the time that you are in. But all said and done, right, it is essentially what you believe in. There are some rules that even you would apply when doing a philosophical based investing. As I said, whether they could be return ratios, they could be market share gainer stories. You might want to identify whether leverage is a problem in those companies, whether over a longer cycle, whether a company is generating cash flows. So these are some of the metrics that even a philosophical based investor would use to gauge the quality of the business over time.
Great. Karthik, any thoughts? Similarity?
Just to add to the points, it's already been made. Essentially, quantitative managers are similar to their fundamental peers in looking for characteristics in a security that will help them identify winners, differentiate winners from losers, right? And the terminology, however, used remains different. So what a fundamental manager would call a thematic approach, we would in quant world refer to as factors. A fundamental manager would call something as earnings catalyst of a stock. I would call it as earnings momentum of a stock. So the language used remains maybe different, but essentially what we both are trying to capture is essentially rooted in economic or fundamental rationale. That remains the same.
Great.
Ratish, is all about patterns. We are all looking for patterns in investing world. As I said, different people look for different patterns. Different people have different time horizons, risk appetite, and depending on that, see, there are only 3 questions in investing: क्या लेना है, कितना लेना है, कब बेचना है. Now, only 3 things are there, and all
Well
these
said.
and we all use different ways to get these 3 answers. But broadly, the patterns of quantitative, fundamentals, technicals remain the same. We all want low risk patterns. I've been a trader before being an investor or a portfolio manager. I've been a trader. I've traded many global markets, and I can tell you, after trading for years, that it's all the same. And there also you're looking for patterns. We used to trade from intra-hour to intra-day to what many trading strategies, but the 3 goals remain the same. Kya lena hai, kitna lena hai, kab bechna hai. You have to manage your risk well. You have to make sure you make money, and then you get it right, as long as you follow a consistent philosophy.
Great, great. Thank you all. So let's move on to another interesting question that I have, and which is actually the reason why we are talking about philosophy based and quant based. Of late, quant based philosophies are, they're getting more popular. Quant based trading is getting more popular, and what's the reason behind this popularity that is coming? Is it because people don't want to use more of their human gray matters, or just let the computers do the hard work? What's happening? Karthik, maybe you start with you.
I think the theories of that form the basis of quantitative investing have been around for a long time. In fact, value investing, as somebody mentioned, goes back a very, very long time. So the theory has always been there. But I think from a business perspective, 3 things have made quantitative investing a lot more attractive. One is computing power becoming cheaper. So you can implement a lot of the theories that you previously had come up with. So the computing power has made that possible. Second thing, you've got these open source softwares like Python and R and so on and so forth that makes implementation of these cheaper. And the last one is explosion in data. Given that data has become like it's the depth and the breadth of data has increased so much that you obviously need to put a structure around it. And that, I think these 3 technical factors have made it appealing from a business perspective. Essentially, it's quantitative investing has become appealing to a business. But from an investor standpoint, I think it also a quantitative approach brings diversification from a product perspective to an investor's portfolio. And that diversification is always beneficial and adds to an investor's portfolio and makes it a lot more robust during a complete market cycle.
If I may add just one point, right? I mean, if you actually look at the last 25 years of investing both in India and the world, apart from these various data sources, even look at the disclosure levels that companies themselves had to make. There was a time when people wanted to know anything about a particular company, they had to buy shares so that they could get access to the annual report. Today, when you look at it, most of even the basic thing like a financials of company, investor presentations, they're all publicly available, and not like in the past where data was just available to a select set of people who were existing investors in that company. So as Karthik said, there's been a massive explosion of not just data sets per se, but even the actual data that comes out from companies as far as disclosure to everyone is concerned. So kind of there's been a level playing field as well.
So the governance and compliance has really played.
Yes.
Amit, any closing thoughts on this popularity?
So why has quant-based trading become popular? Because people have made money. And why have Bitcoin become popular? Because people have made money in Bitcoin. So if you want a concept to be popular, people need to start making money on it. So you've seen Renaissance deliver about 60% CAGR for last 20, 30 years. And that's how Renaissance has now become very popular. This is what Warren Buffett did. How did value investing get popular in the 1990s? Because Warren Buffett made money. So as people make money on one asset class or one strategy, that strategy becomes popular. Going forward, I have no doubt quant investing, trading will get more and more popular because people are going to make money, and wherever people make money in capitalism, other people come and try to chase the same thing. So that's why quant trading has become popular.
Okay. So here is the next one, which is a very interesting question. So is artificial intelligence and machine learning a good data-driven approach to pick stocks to invest in?
So this question is above my pay grade, so I won't be able to answer it.
That itself is a good answer, Amit. So Anand, would you want to attempt it?
So I think like in every segment, artificial intelligence and computing have shown that they can do a pretty decent job. So there is definitely a space for artificial intelligence in investing as well. I mean, I have no doubt how successful it will be. That experience is usually seen over a cycle, right?
Yeah.
And if that makes money, that is also going to get popular, right?
Of course, I'll also start learning about it.
Yeah.
So Karthik,
I agree with Anand there. Essentially, I think it comes down to the kind of data sets you're dealing with. If the data set that you're dealing with can justify the use of AI and machine learning tools, then sure, you go with it. But if not, then these are just tools, right? There are other mathematical models and approaches that help you achieve the same aim. So it totally depends on the kind of data sets that you're dealing with and other portfolio-related constraints if you want to use AI or machine learning.
You know what I learned in this conversation was I learned a good way to get past a bouncer above my pay grade. Okay, so next question, which is what should really one watch out for when one is relying only on computers to make investment decisions, especially and now this is more current, especially in a pandemic like situation. I think every economist had never thought of economy just stopping. So I think it's an interesting question.
Yeah, I'll start off with that one. So actually, if you just flash back a year, right? Obviously, COVID came and hit everybody hard, right? All of us were sitting at home, worrying about what to do next, worrying about our own safety as well, right? There was genuine pessimism in the air. Now, if you would have actually spoken to any companies or even read any transcripts of these companies, whether it was the Q4 or the Q1, you would have had only pessimism, right? And at that point, as you said, most of the economists would have predicted mostly doom and gloom, right? But eventually, I think investing is all about being optimistic about the future. If you're not optimistic about the future, whatever be the time horizon, it might be 1 year for someone, 3 years, 5 years, 10 years, I'm not sure then investing is going to make you money if you're not optimistic about the future. So I think that is one basic human quality which it is very difficult to imbibe in a computer, right? That's what makes us relevant, I think. And I think that no matter what happens, that is something that will keep us relevant. Being optimistic about the future and being able to just look beyond what is happening right now, and assume that whenever the world normalizes, as I said, the timeline could be 1 year, 3 years, but whenever the world normalizes, how it could potentially look like.
I think I love that thought. We have to be optimistic always. Karthik, would you like to add some?
I think we all tend to assume that in a quantitative process, it's only the machines doing the talking and we have no input, right? That I'm simplifying it, agreed, but that's like one of the popular misconceptions, right? But the fact is there is human involvement in every aspect, going from cleaning data to addressing biases to designing the process to executing strategies, right? So personally, I believe when you're going through chaotic times like this or volatile periods like this, what is more important is actually the discipline and making sure you stick to the discipline in terms of the process. Second guessing the process normally has proved to be more painful than not, right? Other than that, things that I would monitor would be to look at how the volatility of the portfolio, the risk profile of the portfolio is changing. And if there are any data issues that are cropping up during these volatile times, because data is central to that process. So those would be the two things I would monitor, in addition to the point that discipline is the key during these times.
So Ratish, my thing is we do use computers for our decision making. We do use computers for our risk management. And once we have our system set, so this is the amount of risk, like a portfolio beta, assuming we do not let our portfolio beta cross the benchmark portfolio beta. Historically, our portfolio beta has been 18% lower than the benchmark. We use it very extensively for risk management purposes only. We don't, as I said, we don't use it for identification of stocks. Of course, we use a lot of screeners, a lot of data, why this will do well, why this will not do well. But places where fundamental data becomes useless is when there is a risk management event, assuming between Feb 21st and March 23rd, in that 32-day period, your Nifty collapsed 40%, right? There is no recession in the world. If you looked at all historical data, there is no recession in the world in last 150 years where the markets have bottomed out in 32 days. And this is the largest recession. We were not speaking about 2-3% degrowth. Here we were speaking about a 33% degrowth in global GDP. So we use it for risk management purposes because the fundamental data is very lagging. So you have to use price action as an indicator to make those decisions, like cutting down risk in your portfolio is very important. And you cannot wait for fundamentals to come out and then say, like the fundamentals would have come out on 15th of April, right? The first quarter numbers would have, the fourth quarter numbers. And that time, if you started selling, you were basically selling at the worst time possible. And from 7,500 to 9,000, in that range, everyone was speaking about a wave 2 coming. If you remember, when Nifty went from 7,500 to 9,000, there was a thought of wave 2 coming, and everyone would say wave 2 aega, this is just A, B, C. CNBC would say first fall is A, then second fall is B, second rise is B, and then you'll have a third big fall, A, B, C. Then when Nifty went from 9,000 to 10,000, Warren Buffett came out in May and said that, you know what, this looks like 1929. And there was an AGM of Warren Buffett. If everyone remembers, that was the headline in virtually every newspaper, and TV channels would just discuss about that for weeks. Then when Nifty went from 10,000 to 11,000, there were more fears of new shutdowns happening around the world. Then like Europe, all those, the wave 2 started. And of course, everyone was calling this a liquidity-led event. From 11.5, around 11,000 point, around 11,000 on the Nifty, you had elections coming in, and the market was, if Donald Trump doesn't come, your market's going to crash down. But what happened? All I'm saying, you need computers. If fundamental data on computers are mostly lagging, it's useless. Use price action for risk management. That will work well for us. This is what we do. I'm just telling you what we do. We use price action for risk management. If something's wrong, it will be, the price will tell you before the event. Fundamentals will tell you mostly after the event. So use your price, your quants or your price action based trading only works for risk management. It doesn't work for either stock picking or how much you buy. You cannot, there is no quant which can tell you how much to buy. So the three questions which I was saying, kya lena hai, कितना लेना है, कब बेचना है. The only third part, कब बेचना है डर के mostly, where you manage your risk. This is where we use some price action. Otherwise, the first two, I don't think exact fact. While I do understand that factor-based investing works, but it is very difficult to quantify the factors because market today works on con calls and not on results. So everyone knows the next 2 quarter results any which ways. There is no person like not the exact numbers. I'm speaking about estimates for next 2-3 quarters. It's already discounting. If you wait, we were taught in school about canceling, okay, how to make money in stocks by William O'Neill. But that approach doesn't work anymore so well because the markets are forward looking. So markets are not going to wait for you to see the quarterly results and then you buy the stock. You have to buy it on the worst, the second the management says, and you can trust that management that whatever he says is right. He typically delivers on what he says. And the second he says that this is the worst is behind us, you'll see the stock zooming up 30-40% even before the next quarter numbers come in. So I will just broadly, I'm going a little off topic, but where do we use quants? We use it only for risk management purposes. Other two things, we do not use it so much.
Okay, thank you so much all. Now, I'll just change my questions and I'll probably just ask one of you a specific question, and if the rest of you have anything really burning to add, you may, but I can sort of quickly move to one question to each panelist. So this one comes to you, Karthik, first one. So given AI and machine learning, can quant-based investing actually disrupt the future of asset management, where the fund manager's job actually sees a transformation the way it is conducted today? What do you foresee in this?
I think, as I mentioned in one of the previous questions as well, at the end of the day, AI and machine learning are just one of the many mathematical tools that a quantitative manager has at his disposal, right? I think more than AI or ML, I think it's more the explosion in data that I think is about to transform all our jobs, right? From portfolio manager to a sector analyst and everybody in between, right? So the point is, given the explosion in data, you have to have a structure around how you process that data, how you clean that data, how you incorporate that data, irrespective of the school of thought you come from, whether fundamental or not. The fact is there is a lot of data that you need to incorporate into your process, and that can only be done in some or the other quantitative form. And so I think irrespective of the approach, more managers, be it traditional or not, will use more quantitative tools as part of their process. And that's why I think it's more the explosion in data that will change the landscape. To give you an idea, so there was a paper in 2016 called Man versus Machines that was published in the US, where the author was trying to segregate funds based on whether they are quant or fundamental based on the description of the fund. And they eliminated using the word quant, as in they didn't use the word quant to describe it, because a lot more discretionary funds were using the word quant in their description rather than the quantitative funds. Just to give you an idea that irrespective of which school of thought you come from, more of them are using the quantitative tools in a way that suits them best.
Sure, and that's a good answer in terms of what's the way forward. And I completely respect the fact that with the amount of explosion of data that is coming to us, especially on the commercial side, from the organizations, from the businesses, obviously computers probably can handle that information coming in a far significant fashion. Okay, so Anand, this question is directed to you.
Yep.
So investment products typically charge 2.5% fee every year, but 90% of these have ever, hardly ever beaten the benchmark over the last 10 years or so.
Yeah.
It outperform. So isn't it a good idea to discard the philosophy-based, human-based fund managers and allocate investment, index funds, ETFs, given the current market valuations, which is, what is suggested over the next 10 years, because given this, we're talking about how to make money over the next 10 years. What would you suggest? Active fund management, passive fund management? What is going to really generate wealth? And remember, here I'm not a coach here. I'm a keen investor, and I'm looking for answers from you guys.
Yeah. Okay.
You guys make money for me, so.
So before I make this question into active investing versus ETF investing debate, firstly, let me be upfront and say that I have time for both styles of investing. I think for that could very well be an individual call as to what the individual is looking out for. If there are certain individuals who have absolutely no time and they're happy to earn, say, 1% more than what a fixed deposit might give them. So you could have such people who will be very happy investing in ETF products for next 5 to 10 years. But one very interesting thing is, and I'm slightly going offbeat here. If you look at the last 10 years, right? Last 10 years Nifty return after this bull market that we are in, right? It's only 10%, right? I mean, you could actually make a case that a year back, had we had this panel, the question could have been as to whether fixed deposits could have made you more money as well, right? So it could very well be a timing issue as well. Now, actually, if you look at the Nifty constitution itself, right, or any other index, right, which typically an ETF would do, right? And the beauty is the constituents and the leadership in market keeps on changing from time to time. If you would have looked at it from say 2005 to say 2007, India Nifty index would have seen massive amount of space for say indices like power, construction, telecom, and now obviously the leadership has completely changed where consumer now is a very big element. So I think what active investing does is that and as Amit said, right, all this passive investing is essentially after the event has happened, right? You're just going to realign yourself, right? I think investing gives you that opportunity from time to time, and there are periods. If you look at the last 10 years itself, right? If we go back to 2013, when we had the CAD crisis, right? I think it was absolutely no-brainer at that time that a rupee was going to, for example, depreciate. All that you could do was take out some of your money wherever you have put and reallocate most of that money into say IT and pharmaceutical segments. You would have made a lot of money. You play that theme and get out. So I think what active investing does do is that from time to time it gives you beautiful options to invest in particular themes, and then you get out of that theme. So I think that is where the role of an active fund manager comes in. Even in products which could be multi-cap products, right? It is actually the active fund manager's responsibility to identify these themes which could work for whatever be the time horizon, 1 year, 2 years, 3 years. It is the active fund manager's responsibility. So which is why I feel that there is the role of an active fund manager in generating alpha. It will definitely not go away. However, as I completely understand that a lot of funds have not beaten the index over the last many years, and I think more and more our industry is becoming a winner takes all game, right? So any active fund manager who is able to beat indices over a period of time is likely going to end up with a large share of public money, public trust as well. So that in short, yeah, that is. But as I said, India, very few people even now still invest in equity. Right, over the next 10 years, obviously that is going to explode, and both styles have their value. I would not want to say that somebody should do only active investing or passive investing. There is time and space for both of these styles to coexist.
Great, thank you, Anand. So Amit, over to you, and I have a very interesting question. And this question is about, as human beings, we are very comfortable talking to a human being, and therefore there's a big comfort factor that comes in giving money to a human person, a human fund manager, philosophy-based, because after all, the investor's emotional state is also important. So can you explain with some examples, one or two maybe, what businesses do you see as leaders in the next bull run? And also talk to a whole bunch of investors who are logged in here as to how do we accept investing right now at these high valuations?
Ratish, this is the best question. Thank you for
See,
that.
the best one for you, because you gave a good excuse, so this one for you.
So, the leader of the bull market. So, as I see, there are two key questions. First is the leader of the bull market, and second is this the right time to invest in the stock market? The leader of the bull market, in my opinion, this is the way we look at it. What are we looking at is large bubbles. Okay, all bubbles around the world. Bubble is so every stock which you don't buy and goes up looks like a bubble to most people. So that is the definition of bubble for me. See, large trends are global in nature. The 1996 to 2000 bull market, where Amazon went up 500 times, you had your Infosys, TCS, Wipro all going up 300 times in that 4-year period. That time, all these companies were growing at 100%. Infosys profit went from 16 crores in 1996 to 284 crores. You need explosive growth for bubbles to happen. Same thing in 2003, and it was a global trend. Same thing in 2003 to 2007, when the real estate bubble happened. It was not just Indian real estate bubble that happened, right? Globally, and globally in US as well, there was a massive bubble happening in real estate, and that's how the subprime crisis happened in the US real estate market. Trends are global. If you see HDIL, DLF, Unitech, these guys don't exist now, but they used to grow at 400%. They would buy land at 5,000 rupees, and boom, the entire flats are sold. And at the end, the price would have become, like in the end of 1 year, the price would become 10,000 rupees, basically double. And you had still a very large land parcel left. So the analyst would extrapolate that, you know, they have 100 acre land parcel. They have sold only 10 acres till now, 90 acres. They will sell it at 10,000, 15,000, whatever price. And that's how the valuation would have come for real estate stock. Between 2009 and 2014, the largest money was made in pharma stocks. In fact, the Indian Pharma Index, and that was a time when Nifty gave zero returns. Pharma stocks were compounding, growing at 40-50%. You look at the entire 5-6 year period, but Nifty earnings growth was 3%, 4% that time, in that 5-year period. That time, global pharma, the Chinese pharma index went up 9x. The US pharma index went up 4x between 2009 and 14. That was the time when SPX was also flat. Indian pharma index went up 7x. Trends are always global. The same thing is happening now. You have a tech trend. Anything which has got to do with tech, and this is so. If you go 7 years back, here again, since you're speaking about the leader of the bull market, I'm just explaining you. Sorry, I'm taking more time. If you see the S&P 500 market cap as of today is $32 trillion. 7 years back, S&P's market cap was $12 trillion. The total market cap addition on S&P 500 has been $20 trillion, right? From 12 trillion has gone to 32 trillion. Out of the $16 trillion market cap addition, $20 trillion market cap addition in S&P, $16 trillion has come in technology stocks. So where is the next big trend? Where is the next big bubble? I expect that to be in tech stocks. Unfortunately, the quality of tech stocks that we have, one promoter today just tweeted, a tech promoter tweeted that his stock is 10x. But I should tell you that we might own it. But his earnings growth since the IPO has been 20%. But the stock is up 10x. So today only he tweeted about his stock being 10x. So leave that. But what I'm telling you, tech is where this decade will be about consumer technology. Companies which are in consumer technology will create the largest market cap we have ever seen before. But they need to be high growth companies. The problem in India, all companies are growing at 10, 15%. They're not growing at rocket speed. Like Amazon came out with numbers yesterday, and Amazon was growing at 43%. And the revenues were $125 billion in a quarter. And Indian companies grow at 10% on a very small revenue base. So that was I'm so sorry. Should I even speak about the second answer? About, or are we late? So about convincing you of investing at right now at so high valuation. Should I say it, or you think we should go to the other part?
No, I think you told me I should go and put my money in tech.
Exactly. Tech is we invest in 4 sectors: consumer, pharma, financials, and tech. Yes, so those are the 4 sectors that we invest in. The largest money will be made in these 4 sectors. Just give me 1 second. Ratish ji, I'll just explain you my philosophy in consumer and pharma. So in one line, I'll finish this question as well. Consumer and pharma is the defensive part of my portfolio. Technology and financials is where I look at growth and scale up. That is how my portfolio is divided. And if any portfolio manager has to change his portfolio again and again based on what he thinks about the market condition, it's the wrong portfolio. In bad times, let's take the first quarter of 2020. That means January 1st to March 20, when the markets were down 35%, our portfolio fall was 18.5%. Basically, we fell half of the market. And the reason why this happened is our consumer and pharma stocks did really well. So basically, if you have these four sectors, which is what we do, you typically do well in bull markets as well as bear market. So you don't have to change your portfolio again and again. Now, if the market falls, my financials will fall, but my pharma and consumer stocks will start going up again. So that is how we structure the portfolio. We don't try to time the market. Nobody can time the market. Believe me, it is virtually impossible to time the market consistently.
Sure. Thank you so much, Amit. And I have a last set of questions, and in interest of time, I've been told that we need to wrap up quickly. So maybe answers can be sweet and short, right to the point. So this one goes to Karthik. Given the structure of the listed space of Indian capital market, it seems if right investments are made in value businesses early in time, I mean, they're less discovered, companies that are less discovered right now by the market. Is that the best way to build wealth? But most often, picking these businesses require common sense, experience, and knack. Can quant-based models do such investments? And secondly, can quant-based investing avoid blunders in doing such investing? What can we expect from, what are your thoughts there, Karthik?
I'll divide into two aspects. One is the return aspect that you talk about, which is identifying winners, and then the risk aspect, right? Yeah. In terms of the return, in terms of identifying these stocks, these so-called corner cases that you said, actually Quant has an advantage because with quantitative process, we are actually monitoring all stocks in the universe as at any point of time, as against a traditional approach where they are zeroed in and focused in on a smaller basket. Where this is monitoring across the universe. So if there is data to support the thesis that the small cap stock is undervalued or the neglected stock is undervalued, and there is growth thesis to support it, then Quant is more likely to identify it, given the fact that it is always scanning the entire universe for ideas. From a risk perspective, to answer your second part of the question, it basically comes down to two things. One is looking at diverse data sources. By that, I mean looking at forward-looking data, backward-looking data, making sure you're looking at a stock from a holistic standpoint and looking at it from all sides. And lastly, sizing the stock.
Yeah.
Which is you size the stock according to the risk. If the stock is very risky, then you size it accordingly so that should a bad event occur, it wouldn't affect you adversely. And which is where Quant helps, because the portfolio itself is diverse, is less concentrated, and so that helps by definition as well. So those would be my 2 points.
Thank you, Karthik. Anand, quickly over to you. And again, requesting for a short answer. So last 3 years, it's been all investing in our own large franchisees, which are probably over expensive, which I've seen from, the basic lens of basic valuation ratios. What do you see are the trends going to be over the next 3 years? So last 3 years, we've seen what we've seen. What's your sense for trends for over 3 years?
So I think I'll again quickly divide the answer into 2 parts. So I think last 3-4 years, both in India and globally, right, you've seen a lot of major events that have happened. And whether it be the interest rates, or in India, whether you look at things like GST, demonetization, right, a lot of events have actually led to what has happened, expensive stocks getting more and more expensive. If you just fill in your cost of equity, if you start making it less, right, obviously the valuations of structural businesses which give you 10% growth every year, obviously everybody is going to pay a premium. If there is one thing that is certain in life, right, I think unless you are in a business which is in a monopoly, right, mean reversion is always going to happen, right? So if you're in a business which is continuously expanding margins, you're going to attract competition as well, right? I think next 3 years, a lot of trends are going to change. We have come from an era where India was slowing down as far as growth is concerned, where now growth is going to pick up over the next 3 years. If you look at some things that have been announced in the budget, healthcare now looks to be a pretty key focus. Unfortunately, COVID happened, and I say it, unfortunately, it took a pandemic for the world to realize that healthcare expenditure definitely for a country like India needs to be higher. So I think next 3 years, themes that I would look to bet on are anything related to healthcare, anything related to technology. I think Amit has gone pretty detailed into why tech could be very important. And the one theme that I genuinely believe will, because we are humans, and I believe that I think COVID has ensured that we have started missing our travel, our entertainment. So I think once situation normalizes, vaccines start coming out to normal public, I think that is also one theme that is going to pick up meaningfully over the next 3 years. And obviously, last but not the least, any growing economy, financials is going to play a very important part for the growth story of the country. And I think over the next 3 years, in the financials, there is going to be a market share gain story where the larger financial institutions are going to gain market share over the smaller ones. So I think market share gain story will be a very important theme across sectors, in my view.
Great. Thank you, Anand.
Thank you. Yeah.
So Amit, last question to you, and you have only a minute to answer. It's a question right up your street. So really, COVID was a big macro event, and I think for everybody in this world, and no one could really predict, that how 2020 started. So let me ask you, were you surprised or were you smart enough to pour everything in equity in March 2020? What I'm trying to basically understand from you is, how does one actually make up one's mind to invest when markets are low during such uncertain times?
So Ratish ji, for me, it's jeena yahan, marna yahan, iske alawa jana kahan.
Kya baat hai.
So see, whatever happens for a stock market investor, he has to stay in the game. For us, it was not a decision to invest new money because we were already invested at the top, right? So we always stayed in the game. We were up 41% since January net of fees, from 1st January to 31st December. So we were still up just by staying in the game. So if Corona comes, stay in the game. If banks go bankrupt, stay in the game. If Joe Biden becomes president, stay in the game. If Mayawati becomes a prime minister of India, stay in the game. Whatever happens, you have to stay in the game. Stocks are girlfriends. Stock market is wife. You do not leave the stock market. You can change the composition of your portfolio, become more defensive, more aggressive. That all is your lookout. But you cannot leave the market. The day you come on cash, that is the time the markets will bottom. So we just stayed in the game. We are not very smart. In fact, if you asked me on 1st January, will I be up 41% in 2020? I would have told you no. If you asked me 1 month after demonetization, that 2017, will it be the best year for 99% of portfolio managers in our country? My answer would have been no. And that was the time Donald Trump became president. We cannot time the market. Why are we doing all that? We have to be in right stocks. We have to buy stocks which are growing faster than the GDP. If we do that for a long time, we'll do okay. So I kept it less than 1 minute, hopefully.
Absolutely. So again, thank you. With this, we come to a close of a very exciting session. And believe me, as an investor, I learned a lot. So really, thank you, Anand. Thank you, Amit. And thank you, Karthik. Really appreciate your insights, your views. And I'll hand you back over to Aishwarya. Aishwarya, over to you. Thank you so much.
Thank you very much. Thank you very much, sir. I think the way you led the session also made it so more interesting. And of course, the eminent panelists were amazing. Thank you to all of you. And thank you to Mr. Ratish Pandey once again. Now with that, ladies and gentlemen, thank you, sir. With that, ladies and gentlemen, I think it's time for me to quote Mahatma Gandhi to define the enlightening sessions of day 1 at the Crystal Gazing Next Decade 2.0. The future depends on what we do in the present. That's what Mahatma Gandhi once said. So with that said, we come to the end of day 1 of our event. And on behalf of PMS AIF World, I'd like to thank all our speakers and moderators who took out time from their busy schedules, marked their presence here, and shared their wisdom and expertise with all of us. Thank you so much to all of you. I'd also like to thank all our partners for the event. Title partner, White Oak Capital Management. Gold partners, Avendus Capital Alternate Strategies, Axis Asset Management, MK Investment Managers, IIFL Asset Management. Our silver partners, Helios Capital India, ICICI Prudential Asset Management, Motilal Oswal Asset Management, Sundaram Alternates, and our media partner, of course, Bloomberg Quint. Thank you. Last but not the least, I'd like to thank all the attendees, viewers. Thank you so much for being here. And I'm going to see you all tomorrow at sharp 10 a.m. We start the day early with an important one-on-one session between Mr. Saurabh Mukherjee from Marcellus Investment Managers and Mr. Kamal Manocha, the CEO of PMS AIF World. And with that, ladies and gentlemen, my heartfelt gratitude to all of you for being here on day one of this event. I'd like to say, stay safe, stay informed. I'll see you tomorrow at 10 a.m. on day 2 of this very, very significant event. This is your host, Aishwarya, now signing off on. Thank you.